what you call order flow and whatever you refer to as order flow, maybe you think of it as contract volume, market profile. Maybe you're using the VWAP in point of control and all those things. To me, if those things help you, that's wonderful. But you're looking at things from a retail mindset. I'm not looking at things from a retail mindset. I'm looking at things algorithmically. These things are going to reprice to these areas because they're coded to do that. The market's going to go right into this little area, this little separation right there. Let me magnify that. So there's the volume imbalance. See that candle's body at close, and then next candle open right here. There's no wick. The open is the high. So that separation right there, that is a volume imbalance. That means that the algorithm has not offered price to the marketplace efficiently between these two price points. So it's kind of like a micro fair value gap. So now when we drop back out, you can see how in that volume imbalance, the market reprices right there, boom. But if you wanted to use this entry here to get in sync with the bearish order flow, the algorithm will price right back up between these two candles because it's inefficiently delivered. There's a gap there. So the algorithm is designed to offer to the marketplace efficiency in terms of both a constant continuum of buy side and sell side. In layman's terms, every price is offered at least 2 times. That means on the pass down, going down, and as the market goes lower, okay, once it passes through a particular price range or a particular price level, once it passes down, going down, like it does here, it doesn't offer a body. So what the algorithm does, it sees that separation between these two time intervals. And the algorithm is constantly cycling from a higher time frame down to the lower time frame. And it's doing it in such a fine level of detail. It's looking for these little pockets, okay? And it's doing it so fast in terms of calculations, it's constantly going through a script. It's seeking these things. And what happens is the market, because there's participants always coming out wanting to do what? Market orders. So when the market's trading up here, at one time, this candle was just about to be in that little shaded area, but it hadn't been there yet. So this was all a bold, bullish candle, green in my case here, but it hadn't got into that little shaded orange area yet. And then someone comes out and says, I want to buy or I want to sell at the market. And the algorithm simply jams the price that's being available to the marketplace to that order that it knows that there's a constant flow of what? Market orders, market orders, market orders. Well, there's not that many market orders. Sure it is. As soon as an area of buy stops get hit, those buy stops become market orders that buy at the market. Whenever there's a pool of liquidity that has buy limit orders, those limit orders get triggered and they become what? Buy at the market. Just limiting how much they will be willing to pay on the limit basis, but they immediately become at the market. Algorithm is absolutely going to go there and offer efficiency. So that's why you're seeing that. And that little movement just above it, that's because that price, on that closing price, to get that price perfectly, it has to go 1 tick above. So what's the closing price on that candle I have highlighted right here? What's the closing price? That's this one right here, okay? It's 41.01 and a quarter. So that means it needs to go to what price? 41.01.50. What's the high of that candle right there? 41.01.50. Hello. Sounds like Daddy wrote something. Yeah. So anyway, you have this order block. Okay, it also trades up into that, but it goes through the order block. How far can it go through the order block, ICT? Well, it's going to go right into that inefficiency right there. Now, that time of day, right here, the market trades up into 8:30 a.m. The news that comes out at that time today was what? Employment data. It was completely random, right? The market rallies up there and goes into that little section of price action and then consolidates right in here. And then starts to do what? Take a dive. Now, I want you to think about the logic. If the market was willing to go up in this order block and it traded up into an area that I teach, this is a volume imbalance, okay? It's not in books. It's mine. I authored it, okay? I codified it. It's here. You're talking to the author. Also, I want you to think about how that shaded area here, that pink area, that's premium. This green area here is discount. If we were to go over, this is where Wednesday's closing price, right before 5 p.m., the last traded price here on the 5-minute chart, we're noting that level right there. And then it opened at 6 o'clock right down here. Now, there's also this March 5th. You see, but I want you to look real close. Without me saying anything, what do you see? Do you notice anything? The new day opening gap here gets filled right there by everybody else's expectations. But is it really? No, it's not. This is simply just repricing back to that level there. So between this closing price here and this candle's opening price, there has been really no trading except for these little wicks. There's a separation right there that has no trading at all. Wicks, I treat those as gaps as well. So in my mind, because the algorithm sees these wicks here the same way we as humans see that gap between this candle's low and that candle's high. So what does it need to do? It needs to pass through 2 times. What does that mean? Where this candle opens, watch what happens. The market trades up through that price point here. In other words, think of that shaded area. We trade from the low of it all the way up to the high of it. Then it consolidates and does what? It treats it as support. Rallies away. Wonderful. Are we done with that gap? I'm not. What is it lacking? Sell side delivery. What does that mean? Well, we've had buy side here, which is price movement up. This is order flow. It's 1/2 of the price delivery continuum that these algorithm theories are based on. You can't just simply call this a gap closure and we're done with it. That's myopic. The algorithm has to do what with this still? Offer sell side. So buy side was offered. That means from low to high, price went up. Now we have to see a pass through on the downside. This is real order flow. The market trades from the high end of it down to the low end of it. Wow. Interesting. It also finds support at that old March 5th new week opening gap low. Well, isn't that interesting? What does the market do then? It rallies back up into that volume imbalance. The market trades up in that volume imbalance, consolidates, hits the order block, remember the 15-minute time frame, and then drops, rallies one more time and fails. Then strong rejection lower.